Moon Platoon. How's it going? Today we are going to talk about the opportunity you had to buy into some Bitcoin. It went up 15% over the last 12 hours, and when people were already crying about things like this, Archegos, margin calls, and other ways the market can take big dips that would ultimately hurt the crypto market that runs parallel to it. Or so you thought. I actually made my very first $10,000 Bitcoin trade in BlockFi for the last few months, down at 50,000, around 49,000 and change. So if you guys haven't gotten your $250 of free Bitcoin yet, you can make sure to do so after you watch this video to the end to talk about a Business Insider article. Wall Street brushed off Archegos implosion, right? The margin call that happened earlier on a couple weeks ago, and GameStop short squeeze in the first quarter, and what you need to know to make sure that you're all caught up. So, hedge funds had the best start to the year since 2006, while banks smashed earnings forecasts. Analysts said buoyant and volatile markets backed by masses of stimulus were key, and it's time to go through it. The only thing that I would say is if you have not seen 1,500 likes on this video quite yet, it's time to smash that like button and then comment out which like you were. It's been a dramatic year for financial markets so far. Retail traders pumped up GameStop in January, captivating the financial world and whacking hedge funds who had been betting against the stock. Then in March, the Archegos investment fund spectacularly imploded, wiping out a $20 billion fortune and sending banks scrambling to distance themselves from the collapse. Yet despite this turbulence, banks and hedge funds just had one of the best quarters in recent memory, smashing expectations and earning big bucks for their clients. Well, not all of them, right? We've known about Melvin not really panning out, and they were the ones that started the fire, the GME fire, that is. And we'll cover all that in just a second. How did they do it? JP Morgan boss Jamie Dimon put it well himself when his bank's earnings came out. Stimulus spending, potential infrastructure spending, continued quantitative easing, strong consumer and business balance sheets, and euphoria around the potential end of the pandemic. Hedge funds turned it around after a rocky January. The year got off to a bad start for many hedge funds when a band of online retail traders decided to pump up GameStop stock. You'll know that this is talking about you. If you have bought into GME or AMC or any of our beloved meme stocks, you'll know that they're likely going to continue painting you in this predatory manner. I'll take a look at Gen X Inc.'s Instagram in just a second. A number of high-profile funds who have been betting against the ailing company, come on, were hit hard. A narrative built up in the media and among the retail investors themselves that a day trading army was laying siege to Wall Street, and in some places it was Gabe Plotkin's Melvin Capital. Oh, the foreshadow, the prodigal Melvin Capital, 49% loss returns on its investments in the first quarter, according to reports. But the GameStop saga was only felt by a handful of firms, says Andrew Beer, very cool name, managing member of Dynamic Beta Investments, an investment firm that follows some hedge fund tactics. Hedge funds have made a gain of 4.8% in the first 3 months of 2021, the best first quarter performance since the heady days before the financial crisis. And if that isn't a sentence that makes you uncomfortable, it's that hedge funds are making money just like they did before the 2008 financial crisis. We've talked to Congress people. We've talked to advisors to presidents, U.S. presidents in the past of exactly what we are expecting to see. A financial crisis worse than what we had to deal with in 2008, a global crisis. According to data from Eureka Hedge, North American hedge funds gained 6.8%. Almost nice. Almost nice. GameStop to me was a tempest in a teapot, says Andrew Beer. Most funds actually did fine because what was more important for them was getting the value rotation right. So some people made bad bets, but it was just a teapot to them, right? It was this big whirling storm, and yet it was contained in a tiny little living space there. They just don't see us as a major threat. Well, as a reminder, we have had Austin Tobit come on. We've had multiple DD writers come on talking about how to predict and prevent the next humongous financial crisis. And if you guys haven't seen those 6 bullet points yet, who are sending out those to Ro Khanna very, very soon. May have already done it as you see this video. The first quarter saw volatility in stock markets as investors positioned for stronger growth, rotating out of big tech into stocks in neglected sectors such as finance and industry. Beers said that the market going through regime changes, hedge funds did well enough because they had flexibility and agility to be tech investors in 2019. This is not saying anything. This is like saying, oh yeah, they made money fairly and legally, and they had no manipulation tactics whatsoever. Well, if you are curious about what kind of manipulation tactics like spoofing, layering, short attacks, short ladder attacks, deep in the money rotation of using put conversions to rotate out FTDs, well, those are just a handful of manipulation tactics. So there are also opportunities for hedge funds who specialize in betting against or shorting stocks, says Mohammed Hassan, head analyst at Eureka Hedge. The growth factor struggled in Q1, creating opportunities on the short side of the book for hedge fund managers as non-profitable technology stocks got a speeding ticket, so to speak, he's told Insider. Okay, that's interesting. People are betting their retirements on these speeding tickets, but I suppose that's a fine analogy to tell people. Banks smash earnings expectations as market income booms. Wall Street's banks also largely escaped unscathed from the Archegos implosion. Morgan Stanley posted a record profit despite taking a $911 million hit tied with the fund. Like hedge funds, the big banks also reaped rewards from highly active financial markets, helping big names like JP Morgan and Goldman Sachs wow analysts with record earnings. Earnings at S&P 500 banks grew a staggering 248% year on year. We can continue, right? We have Bank of America rising in revenue. We have a boom of retail trading, right? Talking about the GameStop saga. As a reminder, just be aware that the more bullish nature that they're trying to pump up the stock with, they're also with an undertone, a pretty clear undertone, that there is going to be a major reckoning in the near future. Crucially, the brightening in the economic outlook after the arrival of COVID-19 vaccines. In addition, the announcement of more major stimulus measures helped banks release $10.2 billion from the provision set aside to cover loan losses, according to FactSet. There's just no doubt that the bear case scenarios that the banks had put into the forecast around building their loan loss reserves have gotten less bad. And that's what we're aiming for. Hopefully that they're just getting less bad. There are a few dangers on the horizon for banks, although many of those involved seem to have escaped the Archegos affair unscathed. Swiss lender Credit Suisse is still struggling, and similar events could yet have broader ramifications. We've already seen exactly what we are worried about when we saw Credit Suisse and Archegos and Nomura go in get margin called, right? You can get margin called too. And this is the easiest way to explain it. We have people who end up getting into some debt, right? Either that you bought shares on margin or you are shorting on margin, which is the same as naked shorting when you don't actually have the share in hand. You can even do it when you have covered your shorts, right? You just need to be able to buy back all those shorts, the shares that you owe people at the market price as it continues to get higher and higher and higher. If you haven't covered those shorts, you can be in a load of trouble. So at the end of the day, we are talking about how a major margin call could end up hurting everybody. Yes, every single person. If you've read the Everything Short, if you've read the new House of Cards CD from Austin Tobit, it's pretty clear the entire economy is going to be affected. The Federal Reserve looks set to keep the party going. Oh no, this is basically dramatic irony in a nutshell. Looks like everything's still okay as far as I can see. So let's see what this says here. Underlying the very strong quarter for banks and hedge funds has been the Federal Reserve, analysts say, which has been made borrowing ultra cheap and pumped cash into the economy and markets. This is not a good, it's like we have plenty of money in the market because someone just keeps making money and we just keep using it. So I think that's actually a really good way to end it on. We have lots of liquidity. Liquidity from $17 trillion pumped by the Fed into these big stocks. And that's the reason why we haven't even seen the pandemic truly wreak its havoc on our stock market. We continue to move upward. And for how long? Well, That's really an ongoing story. If you guys want to be caught up with this ongoing story, the easiest way is to hit that subscribe button. We're on our way to 100,000, real close to 80,000 right now, and we would love for you to come on board. Those of you who have supported the show already, I appreciate you. The Moon Platoon, Gorillionaire, and the Meatball the Space Legend tier, as well as every single one of you that sent a donation through PayPal, Venmo, or down in the $ in live chats for those super chats. I thank you guys so much, and we'll see all of you in the money. Say bye, Meatball. Say bye-bye. No, I'm not gonna juggle this, don't worry. Or will I? I'm gonna try it. No, that's a dangerous idea. It's so dangerous it might just work.
Oh god, please. I'm not cleaning up after you.
Alright, Moon Platoon.